Hello everyone and welcome back to Dividend Compounders with Cheese. In this video, we are going to look at the intangibles, the finances, and run some valuation models to determine if I had $500, would I buy Apple? Apple is one of those companies where I'm not even sure how to give a proper introduction to because everybody knows what Apple is and what Apple does. One thing that I do want to mention is that Apple is one of Warren Buffett's most favorite stocks. Apple is a giant technology company that has its hands in almost every single business segment. I think about Apple Pay, online video streaming, phones, laptops, even chips now, music, and repair services. This is a channel that is focused on dividend compounders. So let's go ahead and take a look at what its dividend profile looks like. The current dividend yield is 0.5%, 0.53%, meaning for every share of Apple that you own, you will be paid 96 cents per year in dividends. The payout ratio is really healthy at 15.66%. So needless to say that Apple is the definition of a dividend compounder. Let's go ahead and look at what its share price was trading at in, 2004, about 46 cents per share. And since then, it has just grown exponentially year over year and consistently. Apple is one of those companies where it is better to just buy and hold. Don't even bother selling, just hold on to it for dear life because the data and the history and the track record shows that this is indeed a dividend compounding stock, which is what we love to see on this channel. The next thing that we are going to be looking at is the historical PE ratio to see whether or not its current trading value is in line with what it was in the past. So if we look at, 2014, the PE ratio was sitting at about 11. Wow, that is really low. The stock price was $16 per share. I just have to repeat that because that sounds bonkers. This sounds like fake news. $16 per share for Apple. I feel like had I known about investing back in 2014, I would have put everything that I owned into Apple stock had I known about investing. But anyways, I want you to focus on the bottom graph, but also the top graph, the share price correlated with the PE ratio. In 2019, that's when it started to hit above that 20 PE ratio, and then the share price went to $71. And then during the pandemic, my goodness, PE ratio hit about 35, and the share price went above $100. And since then, it's just been snowballing and getting bigger and bigger. So I guess its current PE ratio makes sense for Apple's new era of growth. Once they announced that they were going to be making their own chips in-house, the M1 chip, by the way, I have a MacBook Air that I purchased a few months ago. Yes, I know it's old, but it still runs smoothly and beautifully. And they were going to launch a streaming service and everything. I think all of those catalysts helped to propel Apple's share price to the moon, but also their PE ratio now accurately reflects that. Apple just reported their fourth quarter earnings report, and it has the investing world divided. Some people believe that Apple is no longer a growth company because their revenue is finally stalling. This means that Apple is transitioning into being a mature or a slow growth company to their definition. Other investors are more optimistic because they see Apple having a foothold on the younger generation. The brand itself, Apple, there's only certain brands that just resonate with people as being cool or reliable. That includes Nike, Crocs, and Apple. Might I even dare say Starbucks, right? Some of these brands, people will go out of their way in order to purchase it or to have it in their life or to show it as a status symbol. I don't make the rules. It's just, it is what it is. If you are a high school or even a middle school teacher, look around your classroom and you can probably preach to the choir here that almost everybody has an iPhone. And if they can't afford the newest model, they will buy a used or a refurbished like iPhone 12 just to have an iPhone, whereas they could get the new Google Pixel or the new Samsung. Furthermore, Apple is showing double-digit growth in the services revenue, even though their iPhone and Mac sales are not growing as fast. So the investing thesis for Apple's growth for the foreseeable 2 to 4 year future is based on their services revenue growth growing. Every single product that you see right here, like Apple TV, which by the way is the sponsor and is the ones that show the MLS. I'm a huge soccer fan, and their operational gross margin increasing. So the revenue for this quarter was $89.5 billion. That is so much money, which is actually down 1% year over year, but it's up 9% sequentially. iPhone sales was actually $43.8 billion, which was in line with the analysts' expectations. I think some of them wanted to see Apple blow it out of the water and say something like 45 billion, but who are we kidding? $43.8 billion. Oh my gosh. It's shocking to me that so many people wanted the new iPhone 15. I think the only real big upgrade was the fact that its port is now a USB-C rather than their domestic Dunder series. This is the major call out of the latest earnings report. The services revenue, all those different products that you just saw on your screen, was $22.3 billion, which is up 16% year over year. So their services revenue, let me just go back to that real quick. Their services revenue is growing at a rapid rate. Apple is doing whatever it can to just be a one-stop shop for all of your needs, whether it's entertainment related, financial, you name it, they want to be the go-to source for you. And what's crazy about all of this, their gross margin was 45.2%. 45.2%. Oh my goodness. I think alongside with the new M3 chipped MacBooks, the next catalyst in their kitchen is probably this one, the Vision Pro. I feel like this is one of those bougie ass accessories that we laugh at right now, but in the future, this looks like something that you see in a movie, right? It's crazy. All right, anyways, I don't want to show too much bias here, but we want to invest in companies or a service that gives them a competitive advantage, right? The only call out is that more and more people, including myself, are holding onto their devices instead of upgrading year over year. So my cell phone, for instance, is about to hit 3 years old. It does not hold its charge like it used to. It's glitching. I don't get software updates anymore. And yet I'm still not upgrading. Not yet. I feel like I'm not alone, right? It's not crazy to see people holding on to their phones for 3 to even 5 years. And I think that's going to hurt Apple a little bit, but it looks like Apple is accounting for that by expanding their other accessories and offering more services. I also think about the Chinese products that are gaining market share. I read somewhere that the Huawei and Xiaomi brand phones actually gaining the smallest bit of traction against Samsung and the Apple iPhones. But I personally do not believe that Huawei or Xiaomi will ever overthrow Apple or Samsung to be the phone in everyone's hands. Those Chinese brands are gaining a lot of traction in Africa, South America, and in India. Whenever I visit China, it seems like everybody has an iPhone in their hand. And I know that's an anecdotal experience talking, but it shows that the brand value behind Apple is that of prestige, or it's a status symbol. I think the economic moat that Apple has built is going to be hard to overcome. I mean, they have their own operating system, their own ecosystem, their own everything, right? The iPhone is a lot more compatible for their MacBooks. Just everything in their ecosystem is kind of like, if you don't have an Apple product, we're going to make your life a little bit more difficult. And that's one thing that annoys me, right? I have the MacBook Air. Everything else that I own is Android and PC. So transferring files, for instance, is not as easy as you might think. And even the way that you text people, if it's iPhone to iPhone, you get that blue text color, right? But if you have an Android, they kind of single you out and make that green. Are you in or are you out? And that's something that Apple has created, whether it's a good or a bad thing, that is working for their business. Anyways, the next thing that we are going to be looking at is the shares outstanding. We want to find out if the company is issuing more stocks and diluting the shareholders, or are they buying back shares? Buying back shares is good. good thing because less shares outstanding means that each share that you own has quality over quantity. So let's go ahead and take a look at what's going on here. So back in 2010, I guess during the recovery of the Great Recession, there was 25.84 billion shares of Apple outstanding. My goodness. And then they had to keep raising more shares, diluting the shareholders. And that's when the PE ratio was really low too. The PE ratio was at like a 10 or 11 from what I remember. And then they started to, at a very aggressive rate, buying back shares. So hold on. So at a high, we were looking at about a 26.5 billion shares. And then as of recently, now we're looking at 15.8 billion shares outstanding. They have bought back about 11 billion shares. This is a good thing. The next thing that we are going to be looking at is the management team and their belief in Apple. And there's so many different ways that we can measure this. But essentially, for this video, I just want to look at the leadership team. Are they buying more shares or are they selling? Do they believe in the company's future and the vision, or are they selling out? And sometimes it's okay if they sell out. If they have like millions of shares, it's okay to sell a little bit. That way they can buy their fifth house of the year and buy a new jacuzzi and whatnot. So I understand that type, but it's concerning when they sell like, I don't know, 20, 30, 40, 50,000 shares. Go ahead and look at what's been going on in the month of October. It looks like in the month of October, there has been people exercising their options and not a single person has been buying shares. It's only been selling. A senior vice president sold 15,000 shares. This one sold 65,000 shares. This one, oh my goodness gracious, Timothy Cook, the CEO, what is going on here? He sold 240,000 shares. 240,000 shares. That's worth $41 million. Oh my goodness gracious. That exact same senior vice president sold 65,000 shares. So it looks like even within the company's ranks, selling seems to be the name of the game. Maybe this is something that they do every year towards November and December, or maybe they see something that we don't, right? They don't believe in the company's vision anymore. This is just something to be mindful of. All right, so far so good. And I promise, if you hang on, we're going to be doing some valuation models to figure out the intrinsic value and to ultimately answer the question, if I had $500, would I buy Apple stock? The next thing that we are going to be doing is taking a look at the technical indicators. All right, we're going to be doing a quick analysis on the stock price movement to figure out what is going on with this picture. For the past 52 weeks, let's take a look at what the high RSIs were. So it looks like back in February 2023, the RSI hit a 75, which means it was being overbought, otherwise known as it's popular. It's that girl. At the low back in August, when the sell-off first started, it reached an RSI below 30, which means that it was oversold. 27.52 RSI, and another sell-off happened again around October, and it hit an RSI of 30.33. And at that point, it does look like it hit its lower Bollinger Band, and then it rebounded to hit a line of resistance. One thing that I'm always curious about is how did the stock perform during the pandemic? So it looks like during the pandemic sell-off, the RSI of Apple reached a 36.98. The share price, a low of $56. So how does that compare to today? In the most recent sell-off, it does look like the RSI reached a low of about 44, and the stock price is now $168. That is what we call a dividend compounder with cheese. My goodness. Okie dokie, the moment we have all been waiting for. Now we are going to run the valuation models to determine the intrinsic value for Apple, and then to compare that to what the Wall Street analysts believe the price target is. So with the multiples valuation, what we are doing is essentially taking similar companies in the same or similar industry and comparing their valuation from the market to derive a stock price. So the ones that I picked to compare to Apple were Google, Amazon, Netflix, Microsoft, and Meta. I always have this tendency to call Meta Facebook. It's just ingrained into my brain. And in one way or another, they are competing with Apple. So when I think about like Amazon, I don't know, like Alexa versus Siri. When I think about Netflix, the online streaming wars, right? Netflix versus Apple Plus. When I think about Microsoft, I think about their operating system, right? Windows versus Apple's. Google, the Google Pixel versus the Apple iPhone. And then with Meta, the Oculus, I believe it's called, versus the new Vision headset from Apple. And of course, there's a lot more details that we can go into of how they compete with one another. But from that, we derive an intrinsic value for Apple of $213.94 based on how similar companies are doing. Next up is the discount cash flow analysis model. Essentially, we are looking at the free cash flow year over year and taking that, plugging it in with some balance sheet numbers to derive a share price. So it looks like the average free cash flow growth rate year over year has been sitting at 17.37%. That is madness. Absolute madness. I could go with that number, but I decided to be conservative, play it safe. So I decided to go with 8%. So based on an 8% annual free cash flow growth rate, that gives us a share price of $167.12. Moving on is the dividend discount model. Essentially, this is going to tell us the intrinsic value for this company based on its dividend payouts. And I feel like it's not really fair because Apple's stock price has been growing so much and so fast that it has outpaced its dividend growth. But with that said, it looks like Apple does grow its dividend payout, this is quarterly, by the way, and that's annually. They grow it by 1 penny. So the dividend average growth rate is 7.1%. So plugging that in, that gives us an intrinsic value of $114.24 per share. This is not a really fair way to evaluate Apple, but we are going to leave it in. That way we don't just look at a pretty picture, but we also look at the blemishes. The last valuation is the Benny Graham's valuation model. This one gives us an intrinsic value based on its growth rate projection while taking into consideration the current AAA corporate bonds yield rate. And as of right now, that is looking like 5.23%. By the way, I always call the Benny Graham's valuation the bear case. This always spits out the lowest intrinsic value. And that's why I leave it in, because you don't want to just look at numbers that enables you to believe with a confirmation bias. It's good to see the bear and the bull case. So that gives us an intrinsic value for Apple of $72.10. Not a pretty picture. And with that said, we have reached the conclusion. Is Apple a delicious dividend determination, or is it a disgusting dividend? I'm going to go ahead and reveal all this because we just ran through the numbers together. This gives us an intrinsic value for Apple, drum roll please, $141.85 per share, based on the very bearish number from Graham's valuation of $72 and the unfair dividend discount model valuation of $114.24 per share. How did we do in comparison to Wall Street? Let's see what Wall Street says Apple's valuation is. Wall Street predicts that Apple should be about $197.82 per share, which is a 8.8% upside to its current trading price. The low, who is this guy? Who is this guy to say that Apple is $54? I feel like whoever that is, they ran their numbers with just the Benny Graham's valuation, but worst case scenario. $54? Get out of here. The high estimate is $240. Interesting. So anyways, Wall Street says $197. We said $141. So let's go ahead and take a look at what happens when we plug in some numbers and apply a margin of safety. If we are looking to buy Apple with a 10% margin of safety at its current trading price of roughly $178, I get it. Sometimes it's at like 180, sometimes it's at 176. We're just going to go with 178. With a 10% margin of safety applied to its intrinsic value of $141, you are looking to buy Apple at $127.67. Has that been the case for Apple? Let's take a look at its 52-week range. It does look like Apple did reach $124.17, back in January, but since then it's just been going up and up and up and up and up and up and up. So I don't know if you're going to be able to see that valuation again in the next 3 to 6 months, but hey, 10% margin of safety, that's what you're looking at. Now, if we were to delete this one, because to be honest with you, this is not a very fair way to evaluate Apple because they are more focused on growth than they are on their dividend. But with that said, they are still paying their dividend consistently and growing it. So if I delete that from the equation, let's just take a look at what happens to the numbers. Okay, so a more fair valuation for Apple is now $151. But let's go ahead and also delete the very bearish number of $72 from the Grams valuation. Once we delete that, then we reach an intrinsic value for Apple of $190.53 per share, which does seem to be very close to what Wall Street is also suggesting. So with a 10% margin of safety applied to this new intrinsic value, then you are looking to buy Apple when it reaches $171 per share. So what would I do with my hypothetical $500? Well, I'm going to be honest with you, I am dollar cost averaging into Apple right now. And that's because I don't want us to think about just buying a stock and hoping it goes up. I'm trying to change the mentality into believing that you are buying into a company, a business with real operations, with a real service or product. And you're becoming a part owner of it once you own a share. And the senior management team, those are your partners that you're trusting to lead the ship. And remember, it's always better to buy a wonderful company at a fair price than it is to buy a fair company at a wonderful price. So with that said, with the $500, what I would probably do is as Apple trades at around or sideways and hits $175, I think every single time that it hits $175, I will probably pull the trigger and use a little bit of that 500 to buy a share. Because even though Apple's overall revenue might be stalling for the short term, I think their pivot into the services and increasing their gross margins is going to help the company in the long term. Anyways, that has been another video with Dividend Compounders with Cheese. I hope you enjoyed it and stay safe. I'll talk to you next time. Bye-bye.